Welcome back. You are listening to the AI Investor Podcast from 24/7 Wall Street. On today's episode, we are going to look at the market hitting all-time highs, review a portfolio that's showing a lot of green, look at AI in the news, and some of the big checks that Mark Zuckerberg is cutting. All that and more is next. Eric, it's good to see you again.
Yeah, good seeing you, Austin. It is. We've got a friend that whenever the market's like this, he sends us memes that, the meme of the person looking at the wall that's despondent, out looking at the sun, where it's investing is fun again, right? And that means two things. We're checking our portfolio 20 times a day, but it also means things are getting a little overheated. So, we'll talk about that in today's show, but it's definitely been quite a few weeks since we last met.
I was going to say that the AI portfolio is looking fantastic, and we're going to cover portfolio performance in a minute here, but it feels like hot stock summer after the tariff explosion took stuff down. I mean, the rebound was an absolute whipsaw, but and every company now has an AI story. I mean, you and I were talking about it, and that's nothing new, but it does feel like it's even picking up steam a little bit. We're seeing infrastructure plays, and Brookfield with their various Russian doll entity of different corporate structures mentioning AI, and they're an AI play, and every company's an AI play now. But hot stock summer is here. Portfolios are ripping. It's a fun time to be an investor. I congratulate you and any investor that held on through the tariff drawdown, and we'll talk a little bit more about that. But let's just jump into it. Right, the S&P is back at all-time highs. I mean, what is going on? You alluded to this a little bit. Some stuff is looking a little overheated. So let's talk about that. What are some warning signs here? Not that every high is necessarily a bad thing, but this one came very quickly and is coming with maybe some multiple extension as opposed to compression, maybe a little froth, some excess enthusiasm. What's going on?
Yeah, Austin, we talked about wanting to make the show kind of something that people could look back on the growth of a trend like AI. And we do see a lot of people going back and listening to the old episodes and catching up. We do have the portfolio. So, anyone who's listening, if you do want to go back, hear about all the stocks that we've added, it is a great resource for tracking kind of the growth of AI. But if you are listening to this show in the future, you're going to hear 2 months ago us talking about the absolute pinnacle of fear in the market that we experienced in early April. We've actually now seen the fastest V recovery on record. The S&P 500 moved out of a bear market faster than it had in, I believe, any previous recent market history. And it's seen, I believe, the 10th best 12-week period. It's jumped 22% in the past 12 weeks since it bottomed in early April. So, Austin, that's exciting, right? If you're looking at your portfolio, anyone who has stayed invested through this period is going to be very happy with the recent results that they've seen. Now, we've alluded to some of the warning signs that we look for when we're looking at general market matters. Now, what I'm normally looking for are some of the lowest quality stocks running. Are we seeing unprofitable stocks running in a disproportionate, ratio to normal stocks? Are you seeing the companies that added AI to their name outperforming actual AI companies, right? By a significant margin? I'm looking for that. I'm looking at the breadth of the overall market. I believe yesterday we hit an all-time high, or the day before, I should say, in the S&P 500, and only 22 stocks were at an all-time high for that. Less than a third of the market is within 10% of their all-time high. So there is still some concentration to this rally. Another thing I'm looking at, are you seeing accounts posting their returns to Twitter constantly? Mm-hmm. Are you seeing victory laps of accounts concentrated in 5 or 6 very speculative stocks saying, look at me, I'm up 50% in the first half of the year, right? This is, it's just behavior that's very similar to what we saw at the peak of 2021. And I'll add a last kind of warning sign I watch for. What are the downloads on this podcast? Right? We saw last week our podcast that we filmed actually had record listenership relative to just initially being launched. That's great. I would like to welcome everyone who's watching this podcast. I think over the long run, we're going to present some really great ideas, but it needs to be said that generally interest in a lot of these areas is negatively correlated to the market in the sense that as soon as people are getting interested, that's because we've seen that 50% rally and people are starting to look at many of these stocks. And that's often a time that if you begin investing from that point and don't have the stamina to withstand some drawdowns, it's normally one of the trickier periods. So Austin, we'll get to the portfolio in a minute, but I did just want to say, I think this rally, we called that. I think our track record's been very good in calling the general trajectory of the market across the show. But, I am a little bit worried, and we did see some significant rotation yesterday. That's Wednesday, July 1st, out of momentum stocks. If you look at your portfolio going, whoa, that was a reversal. Very overdue, and that's kind of to be expected. You almost never see sustained rallies of this magnitude for the length of time that we've seen.
And I'll add one more fun one here. And I know you and I both experienced this. I've started measuring market froth by how many non-investor friends I haven't heard from in 6 to 12 months start texting me looking for stock ideas. And that number is increasing. Now, of course, we don't want to scare anybody here. It's never a bad time to buy a great company. Amazon has looked overvalued forever, and it's a case study here. And, buying through periods where things looked extended because it was a quality company. So our job, of course, is to try and walk through this terrain of maybe some froth and overvaluation and help you, our listeners, find the best companies that are going to benefit from this trend over 1, 3, 5, 10, 20 years and beyond. So a little word of caution, but that doesn't mean we're cautious about AI, the space. It just means you have to be very, let's say, judicious with where you place your investment. But you have been placing your investments judiciously. Let's look at the portfolio update. I mean, these are not just green shoots anymore. We're starting to see some real growth here. A lot of the stocks, nearly the whole portfolio is in the green. There's some red, but not much. Your most recent GitLab position, the surprise buy at the end of last episode, is already in the green. As of Wednesday morning, where are we at? Walk us through the overall numbers in the portfolio.
Yeah, I looked up. So once again, this is July 2nd. So this is what we're looking at Wednesday morning. The average recommendation, if we're tracking it since the date that we announced, is up 18% across 32 different positions. The portfolio is up 7%, which is less, and that's due to asset allocation. We've got a drag from those larger positions in Meta and Amazon. But, the overall portfolio has just taken a very steep kind of incline since that early April period, definitely significantly outperforming the market in terms of a rebound. We've seen many of the stocks that I've called in the past kind of levered plays to the economy, some of the riskier stocks in the portfolio and things like optics. We've seen them see particular strength. As example, Fabrinet, which for a while was down, I believe 30% plus, is now up 34% since its second recommendation. And we do have 26 out of the 32 recommendations up since the moment we called them. So, Austin, again, I believe we're probably coming through a period where we have something, my expectation is we might see a little bit of a short-term breather. We're definitely not going to keep up the pace we've seen from the early April through kind of end of June period. If you did keep up that pace, we would be dealing with a truly historic market conditions. But, where I would say we've scored ourselves in previous episodes, I would say, where we've done really good, where we've been maybe even a little lucky, I believe our commentary on this show has been generally excellent. We've really stayed steadfast with a lot of the key themes on AI that we're seeing play out, and we can discuss the news of how that continues to play out. I believe since our last show, it is probably the most bullish period for AI since we began recording this podcast, which I've said several times, but it's true. It continues to get more bullish in many areas. During market kind of, let's just call it a freak out during DeepSeek, we stayed steadfast. We talked about some of our unease in the market head into February. In early April, we talked about the stocks that we were buying. We talked about moving past kind of a trough of fear. And now today, we are doing kind of a further kind of high level commentary about noting some caution. Now, I will say, and this is a point that you just made, as much as we do have some caution going into kind of the back half of the year, we are very excited about some of the opportunities we've been talking about recently, like agentic AI and kind of the curve that's going to present in terms of growth. for a lot of opportunities across the market. So, well, we are saying, hey, if you're out there, if you're watching these returns, everyone's going to feel like a genius at this moment. That's just the reality and what the market has done recently. But as much as we are throwing some general caution and saying, it seems like there is some froth emerging in the market, we still are very excited about kind of how a lot of the second half of the year is shaping up.
And, Eric, you didn't ask this, but in the past, you've graded your portfolio, and I know our listeners appreciate it. So I'm going to give you 2 grades here. If I'm looking at the stock picks, and I'm Xing out Amazon and Meta here for reasons we'll discuss in a second, your average pick is up 21%, and that's just a straight average. So I'm going to give your picks an A in this environment. Where I think things have struggled has been portfolio allocation, right? Really big positions in Amazon and Meta, unfortunately, inconveniently timed to a huge drawdown. Those positions net out to about zero today with about $200,000 in each. So I think your picks have been excellent. Where the portfolio is lagging is on allocation. So I'm going to give that a C. But the picks and the recommendations are really where the value has been. I think where we are still working out is allocation strategy. And some of that will shift as there's different trends and cyclicality in this space, whether it's chips or, the interconnects, or we're looking at an inference cycle.
Yeah. And I would say too, I mentioned probably being a little lucky in terms of calling some of the high level themes. We've probably been unlucky in stocks. A lot of ideas that we've discussed, Palantir, which we had made, something we featured heavily across 24/7's website at the beginning of 2024. I had added it to the portfolio. It will have turned into the best S&P 500 stock in that period. It was just a valuation concern. We've talked about Celestica. I got a email from someone this past week saying, thank you for your first reference to Celestica. I bought it. I'm up 227%, but it's not something we add to the portfolio. We've talked about some smaller, riskier stocks in the optics space, like Applied Optoelectronics, which we were talking about last summer at $7. Last time I looked, it's been up and down by $25. So we have left out a lot of high upside ideas from the portfolio that we had otherwise discussed on the show. The hope too would be, as we continue this kind of reallocation towards some of the themes that we're seeing, we will catch some of those ideas, which even at small allocations can really turbocharge a portfolio. So I'm really excited about some of the ideas we're going to have coming in the weeks and months ahead.
Me as well. So, Eric, a little shout out to some of our listeners here, right? We appreciate all of them. Nolan MT, thank you for the comments and reviews you've left. Jesse from Connecticut wanted you to talk about SK Hynix today. Is that something we're going to be able to touch on in today's episode?
Yeah, we'll briefly touch at that at the end. So,
and then Todd from YouTube leaving us comments. Todd, we appreciate you and your time. Thank you for being engaged in our channel here. And to everyone else who wrote it through the peak, the trough and the new peak. We appreciate you staying with us through this portfolio. We're in this for the long run, and we hope you are too. Eric, you've alluded to a couple things, which is this is the most bullish period since we've launched this show. That's a pretty bold statement, but let's actually put some real data and news items behind it. I mean, Oracle, Meta, making huge waves in this space right now. Why are you so excited? And what are some of the news items that are causing you to feel as bullish as you have in a while?
Yeah, we'll talk about it in a minute. We're moving on to the MBA period of AI. It's moving. We are getting into that gawking at some of the kind of salaries coming out, eclipsing pro sports players. But we're also seeing very real news. Austin, I won't get into as many details, but some of the research coming out of Wall Street the past couple of weeks. We talked about in the last episode of the show how Broadcom, in their most recent earnings, their CEO had said, we believe that we could see a significant acceleration in the back half of 2026. And for Broadcom, that's a little more specific to probably some chip orders from companies like Google and Meta. But we're also seeing just rising expectations around AI demand in the coming years, which, again, we've talked about when we first started the show. The question in mid 2024 was, could this kind of bubble, so to say, pop in 2025? And then 2025, we had DeepSeek, and everyone said, oh, this is the beginning of kind of the end of this bubble and spending around AI compute. And now we're looking at 2026 with a lot of projections around maybe even acceleration for a lot of these companies. The estimates for Nvidia have been rising dramatically. The estimates for Broadcom have been rising dramatically. And when estimates for those companies, if companies like Nvidia are winning, if companies like Broadcom are winning, if companies like Taiwan Semiconductor, the companies downstream are generally going to be winning as well. So, we've seen some announcements. Oracle this past week, they, in a surprise filing, announced that they had a customer starting in fiscal 2028 that's going to be larger than their entire cloud business today, right? These are the kinds of things that are now on the horizon. So, Austin, it's just been a lot of background noise that I'm watching has gotten increasingly bullish. And when you're watching stocks in this space rise, yes, it's general enthusiasm for the market. The market's been rising, but there's a reason that stocks like Broadcom, Nvidia, and many of these other core plays are rising 2x, 3x, 4x the size of the market rally. And that is very specific news to the AI market. So, it's been a good few weeks. We've got that. But, I do want to talk about some of the more recent news, such as Zuckerberg's buying spree. Very entertaining.
Let's move on to that. He is going shopping, but I just want to pause here for a beat. I feel like Ellison needs to rename Oracle like Phoenix Enterprises or something for how many times that company has been on the edge of death and come back stronger than ever. I mean, there was near bankruptcy in the 1990s. There was a dot-com bust in the open source threat. They were a late entry to cloud computing. They had their Sun acquisition, and now here they are in AI, more relevant than ever. I mean, I don't know how he keeps doing it, but he makes this company go through every single cycle and come out stronger on the other side. It's absolutely remarkable. Zuck, you had alluded to, is making some superstar salaries. I mean, some of the pay that he's looking at here exceeds, he's not doing leadership pay or even CEO pay. He's looking at like founder legacy net worth pay for some of these hires that are being thrown around. And there is some speculation whether or not Altman might have been playing some 3D chess with his allusion to $100 million salaries. But one thing is absolutely clear. Zuck is getting splashy with the cash, and he is going to hunt some big talent. And whether it's 10, 20, or 50 million, or even 100, they're huge numbers. So what's going on here? What's he doing?
Yeah, first of all, that Oracle point, it is really interesting. So many people are indexed on this idea of technology and large technology stocks being, you're just one shift away from being irrelevant. Look at Oracle's stock chart. Who's talking about Oracle 5 years ago? IBM the last 5 years has outperformed most of the Magnificent Seven. So that is a broader point that, well, a lot of people ascribe higher risk profiles to these technology companies. We've seen even some of the laggards be a lot more resilient. So, you want to think about that as you're kind of allocating for the next 5 or 10 years. Now, as far as Zuckerberg and his buying spree, he is making it rain, as you said, with the NBA. I believe the NBA just signed its largest contract this week, which was Shai Gilgeous-Alexander, who had just won the finals. I think I was in the 70 millions. The report is, and as you said, there's a lot of variations. The offer from Zuckerberg for some of these top people is compensation of $300 million over 4 years, with $100 million in the first year. And, you got to break down what would stock grants versus, direct cash compensation, other matters. But it is truly remarkable. If you want a comparison, the CEO of Microsoft made $79 million in total compensation last year. CEO of Apple, Tim Cook, made $75 million. So he is paying this group that much money. Now, what are the key ideas from this and what it says about the coming future of AI? Well, I would say the biggest idea that anyone listening needs to hold in their mind is that AI spending right now, and we've talked about this throughout the show, but it's two factors. One is the real world usage that's happening. How is AI being integrated across software, operational workflows? And the second has been this fear of missing out, this great race to, in the past it was AGI. Austin, the big shift right now is no one's talking about AGI anymore, which was a little bit more of a kind of, if you were talking about steps to AI being this kind of all-consuming trend of the world, that was AGI, then ASI, which is super intelligence. Now everyone's talking about super intelligence. Mark Zuckerberg is naming the unit that he's building his super intelligence team. And if you think about it, what Zuckerberg is doing is he's going to remove maybe 4,000 employees to pay for 10 or 15. Now, if you are someone who's working at these companies, this is deeply troubling. It's never been more lucrative to be a top 1% employee, and it's never been worse to be average right now. And that's a trend that's probably going to persist for a while. But in terms of if you're investing in this space, this belief, this race for super intelligence, that being something that's game on for Meta and many of the other top minds in AI, really adds to the bull case. Because if we are pushing for artificial super intelligence, that's going to lead to more spending on the compute stack of AI. And if we hit artificial super intelligence, well, who knows what would happen after that? But that turns into a scenario where the limiting factor for more intelligence is more compute, which means, again, a benefit to these companies we're investing in. And if you are someone who can't be getting paid out $100 million in this brave new world, the number one way that you can still benefit from it, which we've talked about on the show, is to invest your personal capital into the spaces that win if this future happens. So, Austin, it's interesting. We had one of the most famous people in AI. I'm terrible at saying names. It's Ilya. What is
Sudavecker?
Sudavecker. I'm so bad at names, but he had started a company that was a straight shot to artificial super intelligence, and it looks like a lot of other people are going to be following, because the race is that people believe if you can create a recursively improving AI model, an AI model that rather than researchers going in and making all the improvements, they're still going to have their hands on it. That's why Zuckerberg's paying them so much. But it begins kind of recursively improving itself. It might be kind of a runaway cycle. And it seems like most the people who have seen the most into the inner workings of AI, have the most access to capital, now believe that this is within sight. Now, is it within sight 2 years or 5 years or 10 years? We're not sure. But they're making their legacy-defining bets on this.
And just to reflect back on some of the Meta position, Meta is a multifaceted AI play. And when I see someone paying this much money for talent, I think froth. I think overspending. I think, forgive me, insecurity. Llama is obviously way outside the top model race. It's all Gemini. It's all OpenAI. Some Anthropic mixed in there. Llama's definitely behind, undoubtedly. So Zuckerberg wants to catch up. We also know that Zuckerberg is not afraid to light money on fire, as he's tried with the metaverse. They famously tried to launch a mobile phone. And yet, Mark is also so unbelievably singular, right? He bet on Instagram, and it's turned out to be probably the greatest acquisition of all time. He made mobile work. So Zuck is singular. He's talented. He's not afraid of making big bets. But the most important thing is Meta doesn't need to win on a model in the same way that an OpenAI does, because they can also use AI to improve their core business, right? Like these are even if they don't win in model traction at a consumer or B2C or B2B level, they can still reap billions in efficiencies in their core business. So it's just there's so much. I feel conflicted about a Meta position, but there's still so much upside. I feel like you got to be in it. You just have to right now on the core business alone. The
risk reward is definitely changing for Meta, but to your point, nothing has changed with the fact that data continues to be the singular most valuable resource in AI, and they probably have the most valuable data. So Nothing's changed on that front.
Yep. Can we talk a little bit about some of the AI revenue run rates that we're seeing? I mean, Anthropic in particular, 1 billion run rate in December, accelerating and multiplying. What are you seeing there on Anthropic and OpenAI's compute bills? Like, what are some other numbers we can use to contextualize consumption here?
Yeah, this is an important point that dovetails with the previous storyline that we had just discussed, which is that you have, we're going to break down what we're seeing in the two streams of what's leading to performance in AI stocks. One stream is this race to superintelligence, which we've seen an acceleration of to a radical degree in recent weeks. The other side is usage, right? So we need to see actual usage. We need to see actual ROI. We need to see AI used by consumers and increasingly embedded in workflows. So Anthropic, you had mentioned them hitting a 1 billion run rate last December, and this is, all reports across the media. By March, we had seen reports of 2 billion, 3 billion by May, and recently there's a report out that they had hit 4 billion. So Austin, when you look at the run rate the company's dealing with, we're talking about 300% increase in about 6 months. Similar to this, OpenAI, there's reports out that their bill for compute, all these, massive data centers that they are leasing out space hand over fist, is going from 4 billion in 2024 to 14 billion in 2025. And I think that number is going to get even higher. So again, we had talked about this FOMO side. Now we're talking about this real world side and some of the numbers involved with it. But the key point here is that all of these numbers are still happening at a time that most AI usage, especially on consumer side, is you having to go and proactively, put in your prompts, put in your queries. You have to be very self-directed on this. The bet that we're making increasingly in the second half of 2025, continuing to accelerate throughout 2026, is that agents are going to pick up, which creates autonomous decision making and will increasingly be embedded in workflows. The point here is that if this agent reality happens, which I'm extremely confident it will, this usage and these numbers that we're seeing is going to continue exploding. So if you're looking for the next catalyst in AI, we're already seeing, 3x, 4x, 5x kind of growth from these kind of leading model companies. There is a huge catalyst to actually accelerate this growth in the next year ahead. And this is a big reason we are so interested in agents right now.
And just to even, to make it boil it down to a layman's term, right? Drawing crayons for me here. If AI consumption is still largely subjected to downstream of like you or me hitting a model and deploying a model, and we're seeing this sort of consumption, it's growing exponentially, but it's still limited by humans sort of querying in a sense and using these models. But when you go into an agent world, one person, one developer can run dozens of agents. Those agents can run multiple hours per day spread across multiple tasks. So we're not talking about a continued acceleration. We're talking about a massive acceleration, right? Once you can use compute autonomously, one person's need for compute explodes and multiplies across agents, multiplies across multiple hours of the day.
Yeah, there's never if you go back and you look at ideas for what artificial intelligence could be, pre when it actually started happening, no one was conceiving you having to proactively script this prompt. It's more of that it was something that was personalized, that would be able to talk with you. It would be embedded in the workflows of how companies work. We are getting to that zone. It's just we haven't quite built the right infrastructure, which is happening right now at this moment. So I think the future that we were promised is being created right now. And if you're investing, you can still get ahead of it, which is a tremendously exciting concept to think about.
Mm-hmm. Yeah. Eric, can we take a little bit of a detour here? I want to talk about something that's personally interesting to me. I am most excited about the real world, atoms applications of AI, things like robotics, things like self-driving, breakthroughs in medicine and medical discovery. Microsoft recently released their medical superintelligence. This is very interesting to me. What's going on here? Talk to us about what this is going to enable and what this application means.
Yeah, so Microsoft, they had released a paper on something called the MAI Diagnostic Orchestrator. What it does is it uses a combination of the models that we've talked about on the show, from OpenAI with GPT-4, Google with Gemini, Anthropic with Claude. And it's what we're beginning to see. We're going to see agents in areas like we talked about with workflows, with consumer personalization. But another area for agents is essentially to sit on top of these models. And what Microsoft built is a group of agents, kind of think of them with all different specialties or personalities, and they work together in what's being called a chain of debate. So what they do is they go and they get data, and then they kind of debate each other so that every specialized agent is able to essentially how'd you put it? You'd say move the conversation forward. And what Microsoft discovered is using this technique, the diagnostic accuracy was 4 times higher than the participating doctors. So, this is, in a way, the beginning of medical superintelligence. And it goes to kind of a bigger point. I've received questions in the past of, hey, when are you guys going to talk about healthcare? And, the honest thing is, healthcare is hard, right? Right? It's going to change substantially, right. But lots of regulations, it's a unique space. But we haven't quite had a way that we want to attack this opportunity yet. So I think we've talked a lot about teeing up kind of broader episodes on agents. And the concept that I am driving towards is that in coming episodes, I want to take something like $50,000. I want to remove that from an allocation like our previous purchases that were outsized of Amazon or Meta, and I want to redeploy it across agents. But the big question is, how do you attack the right ideas? So what companies are going to see their revenue accelerate rapidly in this kind of takeoff we've been elucidating across our kind of news concepts today? Medical, right? You look at the space, there's a lot of ways that you could attack it. You could attack efficiencies in places like insurance, or you could attack it by buying actual companies that do some of the simulation software. An interesting way to play it might actually be the data angle. And I think that's kind of, we're seeing the light from something like this news story, that you look how these agents can create specialization over general purpose models. A lot of medical data isn't accessible to these general purpose models. It's buried away. It's hidden in silos. It's controlled by many companies. And it might be that the way that we start attacking kind of this healthcare opportunity is to buy the companies that own this, unique data that these generalized models are going to need to actually work with more specialized techniques, including like these specialized agents that we saw from this Microsoft study. So I just want to highlight this because it is an example of, a lot of, we've received a lot of questions about how do you kind of invest in this agentic opportunity. And this is an example of the research that we're seeing of a news story and how it's going to connect to what we believe are winning investment outcomes, and how we might attack a space with an idea that doesn't sound directly connected to this agentic idea, but is really a catalyst. So I think it's an exciting news story, Austin. I think we can all cheer getting better medical care. Hopefully this leads to better results for all of us throughout our lives, but it also probably has a very connected investing opportunity as well.
Yeah. This is a very lazy observation, but I do think it's true. One, medicine is just hard. HIPAA regulations can bind models and providers, and the risk of associated giving poor advice just is so high that it's going to be a hard space to unlock. But the mega tech companies are actually really interesting ones to watch here. Like Apple has access to unique data through they have a really robust health program through Apple Watch. And there's discussion about AirPods becoming medical devices. Google obviously making incredible advancements with AlphaFold. One of the ones that I'm most interested in, and they haven't really landed it yet, is Amazon, right? Amazon famously teamed up with Berkshire and Chase on Haven, trying to reimagine healthcare, and it didn't work, but they clearly have ambitions here. If you think about them, they have the built-in installed base of a lot of Alexa devices, maybe even Echo Show is something here where you can kind of talk to a doctor and be like, oh, look at this rash, They've also got an Amazon Pharmacy, and they've got their Amazon One or Medical One program. So Amazon, of all the mega tech companies, seems like the one who's taking the most different tacks to try and make medicine work. That doesn't mean you should buy Amazon for their upside in healthcare, but that's a really interesting one to watch, the ways that they're playing it. How are they going to be applying AI? In the meantime, we're also, of course, going to be looking at a lot of the smaller companies that could be applying AI or utilizing the data, as you said. But the big tech companies here actually are kind of some of the most interesting early healthcare companies to watch, actually, depending if you think it's going to be a wearable play or, a web-based virtual doctor play or a prescription play.
Yeah, I think, if we had done a podcast the past 15 years that we've been talking about investments that was just named Lazy Investing Ideas, it probably would have beat over other ideas. I don't know how many listeners we would have, but I think there's always merit in these ideas that often, to what you said earlier, what you can draw with a crayon is tends to be a little bit more powerful than we give it credit for. So I really like that point. I do think this is an area where you look at a company like an Apple. Well, what's its weakness? It's not going to have that foundational model. It's not going to have that general purpose LLM. But if it does have this personalized health data, and it has this larger pool, and it's able to kind of build out more specialized agents on top of it that are able to give meaningfully better results, that's an entry point where maybe they lost that one overriding strategy, but they're able to offer something that's extremely compelling value to consumers. So, right, this is where you start to see the nuance of, who's going to be able to win in this brave new world.
Mm-hmm. Speaking of drawing with crayons, the most exciting, simplest, but also most fun application of AI for me is robotics. I want to talk about the Jetsons. I want to talk about robots going around our house, doing our dishes, folding our laundry, picking up my groceries. Jensen Huang seems to be, maybe he's just getting me really excited here, or he agrees with the potential. But he said robotics and AI are the two biggest opportunities for Nvidia. I think it's a peanut butter and jelly marriage here of technology and potential. What's going on here? Nvidia sells the necessary equipment for both sides of this to work. But what are you read in his comments and his recent enthusiasm about robotics and AI?
Yeah, like you said, peanut butter jelly, robotics, much like self-driving cars, is extension of AI. So are robotics, and it's just what are the timelines for these markets happening. This was at NVIDIA's, I believe it was their annual investor event. And Jensen made the comment that the two biggest opportunities, and he put them side by side, AI and robotics. So that's going to catch some news. And what I'm kind of seeing in the robotics space is it's interesting. At the beginning of GPUs and the birth of kind of artificial intelligence use of GPUs, NVIDIA won a really key battle, which was creating the platform, which is famously their CUDA software stack. And right now we have a similar battle going on where NVIDIA is just relentlessly shipping tools to the robotics space, allowing them to take advantage of some of the really scalable advancements right now, which is basically open world simulation, which is things like reinforcement learning. A lot of these areas, NVIDIA is not only building out kind of the software stack, it's building out a lot of the tools that are essential if you want to keep up. So it certainly seems like we're at a stage where robotics is on a steep acceleration. And NVIDIA has, once again, it is beginning to repeat the same process of becoming the core central platform it did in artificial intelligence to this space. Now, the question, Austin, of course, and we're going to do a more deep episode on this in the future, is what is the potential takeoff for this? Because, self-driving cars will almost certainly, we discussed them on the last episode of the show, they're going to be right. They're going to be massive, and it is happening right now. But, a decade ago, we knew that was likely the future, and it took a decade, right? And is it going to just be a lot steeper takeoff than self-driving cars that might just fantastically improve from, 2024 to 2027? And will that lead to a lot of general purpose robotics? Because what we're seeing is some of the advancements in technology. We used to think about specialized robotics. What robotics is getting good at is it can actually get significantly better just by analyzing humans and how we move. And that's leading to this explosion to have more specialized in general purpose robotics. So we'll probably see that more in kind of a factory setting and eventually into the home as kind of a second wave off that. But it is notable that NVIDIA, this might be a 5 to 10 year payoff, but they have positioned them very well. And it's telling that Jensen Huang wants to make this a focus of their future, because they're not going to make this the kind of stand of their PR and narrative without them believing that we're going to see some significant kind of acceleration in the real world in the coming years.
And, if anybody wants to, if you'd like sort of like a tangible, maybe an appetizer of excitement for the potential of a robotic chair, I'd like to give our listeners a brief homework assignment. The Journal had a great article on Amazon. The title of it is Amazon is on the cusp of using more robots than humans in its warehouses. This article is fantastic, and it just talks about some of the potential here. And I've gotten a little hung up in the past on, is the future humanoid robots versus special purpose robots? And I think the answer is just yes, it is both. And Amazon is sort of demonstrating that in a real world way right now. 75% of packages that are coming out of Amazon currently are a robot is involved in the process. The number of employees at their facilities, their warehouse facilities, have actually declined since 2020 because they're leveraging robots at a much higher level. And that's just going to be the way that you can leverage robots and robotics extends even more once you are able to layer AI in it. So I agree with Jensen Huang here, and Amazon is sort of showing us the potential of robots, largely purpose-built, not humanoid, but I'm here for the future with robots. I'm excited by this. And I think this is a great article if anybody wants to take 10 minutes and just sort of contextualize some of the potential here. Eric, before we round things out here, is there anything else you want to touch on? We had said we were going to answer a question about SK Hynix. You had a note you wanted to disclose about GitLab as well. Anything else you want to end on here before we wrap it up?
Yeah, we won't take up an incredible amount of time here, but I received a note from Jesse, who's a frequent listener of the show, asking about our SK Hynix buy that we had announced in January. Unfortunately, we didn't complete that buy, partially because it proved a little more difficult to add than other stocks. We moved on to other opportunities. We had Micron as alternative memory play. It's worth noting, Micron this past week, really outstanding earnings. The acceleration in the high bandwidth memory market continues and should continue to grow at a substantial rate for years to come. They didn't see maybe the returns you might have expected by looking at the results, partially because they weren't able to give as much certainty on 2026 sales because they're still in negotiations. One big feature of this market is you have three players in SK Hynix, Micron, and Samsung. And Samsung has just, I don't know what to say, hasn't been able to get its, S together.
Together. There might be children in the car, Eric.
We will keep this rated PG. So that situation has not changed since the initial recommendation. Jesse bought on the German stock market. I believe that is the most addressable way to buy SK Hynix. Unfortunately, the South Korean stock market remains incredibly hard to be able to purchase individual equities. So I wish we had put in the portfolio. I believe it's up more than 30% since we had issued as a recommendation. Unfortunately, I think we just, as far as the actual portfolio, we will stick with Micron as the kind of HBM direct play there. Now, another portfolio note, last week I had announced that we intended to purchase GitLab. I've also, in recent episodes, talked about how due to some of the work we're doing for our own company, we do have to comply with larger disclosure rules. And I have been unable to purchase GitLab. When we purchase it, I will add it to the spreadsheet we keep. If you are looking for that spreadsheet, you can search $500,000 AI portfolio. Unfortunately, Google search is terrible and continues to get more terrible. So you will see a spam article spun up to try and win that keyword. You'll probably see 4 advertisements on top. But as a 5th or 6th result, you will see the actual thing you're looking for. So, you can go and you can look at past portfolio results, but we will add that as soon as we're able to. We just have to comply with kind of those disclosure rules, and that will move forward. And that's why we are tracking recommendations from the date we publish podcasts, is because we know we won't always be able to purchase them. So we want to, accurately score ourselves according to when the ideas come out, and also portfolio returns, but those will increasingly diverge from the advice we are giving to you, the listener. So Austin, that is it from me today. I think, we'll be back in a couple weeks. I continue to be on the hunt for kind of recommendations along this agentic opportunity. I'm targeting, $50,000 worth of investments, but, I continue to qualify ideas, and we do have some time on this. The takeoff isn't happening in the next couple weeks, right? This is This is a trend that's going to be playing out across the next 6 months, 18 months. So if you're looking for new stock ideas, if you're excited right now, I think we're going to have a good selection of them in the weeks to come. So that'll be exciting.
Well, Eric, as always, thank you for your expertise and guidance. And I am particularly excited. Not only is the portfolio in the green, but we are now fully allocated, which means we now get to move into the multifaceted and dynamic world of selling positions in order to get exposure to other positions. So things get a little bit more complicated at this stage, but it's exciting. And I hope that our listeners appreciate all the work you put into managing a portfolio and finding these opportunities. So until next time, listeners, enjoy summer out there. Enjoy hot stock summer and this rebound that we're seeing. We'll see you next time.